the SEC. I just want to mention a couple of logistical points here before we get started. We are offering CPE credit during the program today. So if you'd like to receive CPE, or if you have, or specifically if you have indicated that you do want to receive CPE, please make sure that you answer the CPE questions that will appear on your screen at a couple of points during the program. Also, if you are having any kind of technical issues, please email us at support, SUPPORT, @xbrl.us, and we'll do our best to get you back online. If you have questions, please use the Q&A link that you see on your Zoom console, and just key your questions in there, and we'll take them as we go through the program. So with that, I'm going to go ahead and move on to our first slide here. We'll just look at the agenda. Our first topic is going to be trends in data quality of SEC submissions. And we're very happy to have with us Shelley Waveren. Shelley is advisor of Toppan Merrill XBRL Consulting Services. She is also the chair of the XBRL US Data Quality Committee. We'll then take a couple of CPE questions, and then we'll move on to XBRL data use and get an update from the SEC with Julie Marlowe. Julie is Assistant Director in the Office of Structured Disclosure at the Securities and Exchange Commission. And then finally, we'll have an update on data quality rules from Campbell Pride. Campbell is President and CEO of XBRL US. We'll then take a couple of CPE questions, and then we'll follow up with any additional audience questions that we have. But please, again, make sure that you post your questions in on the Q&A, and we'll take them after each portion of the event so that we address them as quickly as we can. All right, so thank you very much. And with that, I'm going to turn it over to Shelley Waveren. Shelley.
Okay, thank you, Michelle. Can you go to the next slide, please? Okay, so before we get into the trends of data quality, I want to first give you a summary of the guidance and validation rules published by the DQC so far. For the guidance, most topics are related to tagging US GAAP or IFRS financial statements, but there are also topics relating to tagging items outside of financials, for example, the insider trading arrangement disclosures, proxy disclosures, as well as some Q&As explaining certain test filing warnings. And as for the validation rules, we have published a total of 167 DQC rules since 2015. They are 3 deprecated rules because the concepts checked by these rules have been deprecated in the taxonomy over the past few years. We also have a total of 9 rules that are not yet effective. So at this time, we have a total of 155 effective DQC rules. 119 rules apply to US GAAP filings, 15 for IFRS filings. We have 18 rules apply to both US GAAP and IFRS filings, as well as 3 rules that check the proxy filings. Please. So the DQC has been collaborating with the FASB to include a selection of DQC rules into the US GAAP taxonomy. The taxonomy that includes the DQC rules is called DQC Rules Taxonomy, or DQCRT. The DQC Rules Taxonomy was created in the year 2020, and in the first quarter of 2021, the SEC started to incorporate the DQCRT into its ecosystem. So filers will see the errors flagged by these DQC rules in their SEC test filing result. And since the creation of the DQCRT in 2020, the FASB has been adding more and more DQC rules into the taxonomy every year. And that's how we get to the total of 60 DQC rules in the 2025 taxonomy. I want to point out that not all DQC rules are included in the DQC rules taxonomy yet. And that is because the FASB has specific criteria they use to decide which rules get selected. The rules that are currently effective will continue to be used by filers in the market to make sure they don't produce false positives And based on the feedback, we can still adjust the rules to make them more accurate or more effective. Once the rules are stable and require no further adjustments, that's when the FASB will add them into the taxonomy. And it is also important to know that the DQCRT is a part of the US GAAP taxonomy, so it does not and will not include DQC rules that are only applicable to IFRS filings. So on this slide, you can see that the majority of the DQC rules published in the earlier days, 2016 through 2020, the majority of them have been included in the DQC rules taxonomy, and every year the FASB will continue to assess and select more rules to add to the taxonomy. Next slide, please. And as I mentioned earlier, the SEC EDGAR system incorporates the DQC rules taxonomy. It will produce warnings to alert filers that they have tagging issues to review before submitting their filings. I think these warnings have been extremely helpful and have definitely contributed to improving data quality. This slide here is an example just to show you how effective the DQCRT is once it is incorporated by the SEC EDGAR system. So in 2021, the SEC first incorporated 6 DQC rules into the EDGAR system. Well, as you can see, there were about 43,000 errors in total for these 6 DQC rules in 2020. But in 2021, as soon as these rules are incorporated in the EDGAR system and filers can see the tagging errors in their test filing result, the number of errors decreased dramatically to about 25,000 in 2021. And as filers continue to see these warnings and learn to address the tagging issues, the number of errors on these 6 rules continue to decrease. And in the year of 2024, the number of errors was very low as compared to 3-4 years ago. And I can tell you that we see the same trend for the 9 rules added in the 2022 DQCRT. There were 7 rules added in the 2023 DQCRT, as well as 24 rules added in the 2024 DQCRT. And this March, when the SEC approved the 2025 US GAAP taxonomy, 14 more rules are included in the 2025 DQCRT and incorporated into the EDGAR system. I think this is a great collaboration. The DQC works with the FASB to develop and add rules to the DQC rules taxonomy, and then the SEC incorporates the taxonomy into the EDGAR system, making the tagging issues visible in test filings. This helps filers to identify their tagging issues so they can fix the problem before submitting their filings. Next slide, please. As for the DQC rules that are not yet included in the DQC rules taxonomy, I want to go over 2 rules with the highest number of errors in 2024. The first rule is DQC number 156. This acts an error when filers use a custom element to tag their earnings per share when the basic and diluted values are presented as one single number. In other words, the basic and diluted earnings per share values are the same. Well, we know this happens when the company has a net loss for the reporting year. And the reason that filers use a custom element is because there used to be an element in the taxonomy that represents basic and diluted earnings per share. But in 2022, this element was deprecated. So how should the filers tag this value? Well, the FASB published a very clear guidance that the correct way to tag this value is to use 2 standard taxonomy elements, the basic earnings per share and diluted earnings per share, and tag the same value twice. So we created this DQC rule to enforce the concept. DQC 156 became effective in September 2023. And in the rule error message, we explain why the error was flagged and also communicate the correct way of tagging. And in May 2024, we see that the SEC published a data quality reminder that discussed the same issue. We are very happy to see that over the past few quarters, as filers continue to pay attention to data quality, the number of errors for this rule has decreased from over 2,500 errors when this rule first became effective in Q4 2023 to less than 400 errors in Q1 2025. Let's move to the next slide, please. And the DQC rule with the second highest number of errors in 2024 is rule number 145. This rule checks incorrect cash flow presentation. It is created to make sure that filers are building their presentation link bases correctly. For example, on the statement of cash flow, an element that represents operating cash flow should not be placed as a descendant under the investing or financing cash flow abstract. This DQC rule became effective in Q2 of 2023, and the SEC also published a data quality reminder on the same subject in March 2024. Again, we are happy to see that over time, as filers and service providers continue to run DQC validation, learn about the issues, they are able to resolve the errors before submitting their filings. The number of errors for this rule has decreased from almost 2,000 errors when this rule first became effective in 2023 to only about 150 errors in Q1 2025. I think that is a very big improvement. Slide, please. So this slide here shows the relationship between the DQC rules taxonomy, and the data quality reminders published by the SEC. I think these three components work together to improve the data quality in the US market. In many cases, the DQC identified a common tagging issue, and we created a rule to flag an error for filers to review. And around the same time, the SEC often also observed the same issue and published a data quality reminder to draw filers' attention. In other cases, I think the process may begin with the SEC when they notice the recurring tagging issue and publish a data quality reminder. The DQC would evaluate the reminder, and if we don't already have a corresponding DQC rule, we would create a rule to help capture the issue. And generally, the DQC rules are created based on inputs and feedback from many different sources. We have many rules created to address taxonomy modeling implemented by the FASB. We also listen to the data users and create rules to catch errors that challenge data consumption. And both SEC and DQC are reviewing filings and analyzing trends. And this slide here shows you that the tagging issues that we observed are often very similar. And I should also mention that the DQC meets with the SEC twice a year to share our data quality analysis, and the FASB participates in those meetings as well. Again, I think we have a very good system here. The DQC creates validation rules based on the input from the FASB, the data users, SEC, or our own observation. And then the FASB would select and include the DQC rules into the DQC rules taxonomy. And once the rules are included in the taxonomy, the SEC incorporates the rules into the ECR system, which makes the tagging issue visible to filers in their test filing. So the filers have the opportunity to fix the issues before submitting their filings. With this level of collaboration, I believe the XBRL data quality in the US has improved a lot over the past few years, and I truly expect that it will continue to improve even more in the future. That's all I have for this part of the presentation, so I'm going to hand this back to Michelle.
Shelley, thanks very much. We're now going to go on to a couple of CPE questions, and then I'll be turning it over to Julie Marlowe. Okay, so first, for those of you who are interested in getting CPE, hang on one second. I'm going to pull up the polls. Okay, so let's take our first poll question here. Hopefully you should be able to see this on the screen. How many DQC rules have been incorporated into the 2025 DQCRT? Is it 110 rules, 60 rules, or all DQC rules? Okay, just take a few seconds to respond to this one. We've got about 30 seconds to go. Okay, just about another 10 seconds. All right, we're going to close down this poll and we'll go on to poll number 2. So hang on one second here. All right. Which federal government legislation requires the SEC to publish a semi-annual report to Congress on public and internal use of machine-readable data for corporate disclosures? Actually, I think, well, let's go ahead with this. Okay, the Open Government Data Act of 2019, the Financial Data Transparency Act, or the FDTA, or is it the Digital Accountability and Transparency, or Data Act? Which government legislation requires the SEC to publish a semi-annual report to Congress? All right, we'll just take another 15 seconds or so for this one. Okay, I'm going to close down this poll. All right. Thank you very much for responding to that one. And now bear with me a second. I'm going to pull up a separate set of slides here. All right, great. So you should be able to see the SEC's activities on data quality. And Julie, thank you so much for joining us for this. I'm going to turn it over to Julie Marlowe in the Office of Structured Disclosure at the Securities and Exchange Commission. So Julie.
Thank you, Michelle, and many thanks to Shelley and Expero US on their efforts on data quality. We enjoy working with them and greatly appreciate their efforts. Next slide, please. I'm going to start with the disclaimer. Today's presentation is provided in my official capacity as the Commission's Assistant Director of the Office of Structured Disclosure, but does not reflect the views of the Commission, commissioners, or other members of the staff. Next slide, please. Here's what we'll discuss today: our team's work on data quality and data quality guidance and trends, common recurring data quality errors that we have observed, how the SEC staff use structured data as laid out in the FDTA, Financial Data Transparency Act, report to Congress, data sets our team publishes for free use by the public, and we'll end with a list of resources. Next slide. In addition to engaging in rulemaking and developing analytic applications, our team reviews filings and related data and perform data quality assessments. We issue data quality reminders on specific data quality errors we have observed, perform custom tag analysis annually, and work with other divisions on addressing those issues. Data quality reminders focus on a specific issue, such as scaling errors in public float, incorrect use of outdated tags for certain disclosure, among others. We've also posted our observations and guidance and FAQs on interactive data as well. Further, we publish annual trend analysis custom tags. So here you're seeing the 2021 through 2023 gap tags. We will publish the 2024 once we have all the 2024 data. But you can see it's about a 20% average across filers. We may see a little bit of an increase in custom tags if we have a new accounting rule or SEC rule, but usually for gap filers at about 20%. Also, you may be aware that our division does not have the delegated authority to contact the filers directly. We have to rely on policy divisions to do so. So policy divisions such as corporation finance that oversees operating companies have issued comment letters on data quality, such as missing XBRL data, incomplete tagging of financial statements and notes. Next slide, please. So what type of errors do we still see? We still have filers that do not provide XBRL data for financial statements and notes. That is non-compliance with the 2009 Interactive Data Rules and the 2018 Inline XBRL Rules. We also see filers inappropriately creating tags when standard tags exist for those common disclosures such as property, plant, equipment, accounts payable, revenues. And we continue to see scaling errors on certain disclosures such as common stocks outstanding. Also, with new SEC rules expanding to narrative disclosures, we see some filers not tagging policies or narratives such as clawback policy. Next slide, please. So let's dive into specific filings. So in this example, a filer correctly showed 28 million common stock shares outstanding on the cover page. But for the same disclosure on the balance sheet, the XBRL data is $28,000. Clearly a scaling error. Next slide, please. In this example, the filer created a custom tag for basic and diluted earnings per share when there is a standard tag. The beginning of the tag name is hidden, but that was the filer's ticker symbol, noting it's a custom tag. SEC rules allow filers to create custom tags for unique disclosures, and if there is no corresponding standard tag. But custom tags inhibit data users' ability to easily extract and analyze and compare data. Further, there's no reason to create a custom tag for a standard disclosure like basic and diluted earnings per share. Next slide, please. In this example, rather than showing you a text without any tagging of the clawback policy, we want to share a properly tagged disclosure. So this filer properly tagged the pay versus performance tabular list, specifically these financial performance measures used by them to link the CAP, compensation adjusted for performance for their officers. As you've seen in this slide, we all have a role to play in ensuring high quality data. It's filers' responsibility to ensure accurate and completeness of their XBRL data that enables effective consumption by the data users and other investors. And financial reporting process should include checking the quality of their machine readable data. Next slide, please. As a refresher, in December 2022, Financial Data Transparency Act was passed and requires the Commission and other financial regulatory agencies to adopt open data standards, among other requirements. Under the FDTA, our agencies also require to issue a semi-annual report on the public and SEC staff's use of machine readable data for corporate disclosures. Please check out our latest one, December 2024, which covers the staff's use of data to identify filer types that used for accounting purposes and enforcement actions resulting from the use of data, among other discussions. The next report is due in June 2025, so please stay tuned. Next slide, please. Let's move to a specific use case as laid out in the congressional report. So the corporation finance staff, so that's the group that oversees operating companies like Amazon, Meta. They use structured data in certain annual forms like 10K, 20F to identify issuers that are subject to certain disclosure and submission requirements. So for example, under the Holding Foreign Companies Accountable Act, the filers are required to structure the auditor name, auditor location, and PCAOB number. Corporate staff also review structured data that appears on the cover page of the annual reports to identify, count, and sort and analyze the registrants and their disclosures. Both CorFin and our division staff review structured data in the financial statements and notes contained in filings under the Commission rules. Next slide, please. The investment management staff, so that's the group that oversees investment advisors and investment companies. They have their own disclosure review group and an analytical group, and they're super users of data. They have used structured data to detect errors and inconsistencies within filings and to identify funds with certain characteristics and risk parameters. Office of the Chief Accountant Staff. They oversee PCAOB. They work with FASB and IASB on accounting standards and other foreign regulators. They have used output from our analytic applications to conduct research for accounting consultations, information gathering relevant to accounting standard setting projects, and to prepare speeches and specific data requests regarding registrants' application of accounting principles. Next slide, please. Our staff maintain and update 14 data sets for the public's use. These are free, and we update them either monthly or quarterly. We often get questions from various data users, such as investors, academics, financial firms, and other federal agencies. Financial statements and notes data are among the most heavily downloaded items on the Commission's website. Please take a look and contact us with questions at structureddata@sec.gov. Next slide, please. I'll end the presentation with links to more resources. Our website includes links to staff observations and guidance in data quality. For technical questions and tagging, please contact us at structureddata@sec.gov. For compliance questions, even tagging compliance questions, such as, does this disclosure need to be tagged? That really is best directed at the policy divisions, either corporation finance, investment management, or trading markets. We do often work with them on those questions, but if it's a policy question as to what something needs to be tagged, that belongs in those groups. So please contact them at the information noted on the slide. The last link shows all announcements issued by our office, including the updates on taxonomies and data quality. Once you're on that link, select the structured disclosure in the drop-down menu, and it will show all the announcements that we have issued. This concludes my presentation, and thanks for your time.
Julie, thank you very much. We actually have a couple of questions that I'd like to take before we move on to the next portion. And Julie, why don't I give you the first question, and the second question I'll give to Shelley, because it's we'll kind of go backward here a little bit. But so Julie, the question came in, can you further elaborate on the specific issues cited with the share presentation on the cover page and in the balance sheet? The individual says, I've been an XBRL preparer for more than a decade, have reviewed the publications on this topic, but I don't understand the specific issue that we need to be aware of related to this DQC rule.
I'm guessing it's talking about the scaling error?
Cited with the share presentation on the cover page of the balance sheet. Do you want me to move back in the slides to that?
Maybe it was slide 6. If that's the case, it was a scaling error. So the 3 zeros are missing on the balance sheet versus what was the correct on the cover page. So we often see some of the zeros missing on one disclosure for the same disclosure in the same filing. So the common stock shares may show up multiple times in the filing itself. On the cover page, the filer got it correctly with the 28 million versus on the balance sheet, it's missing 3 zeros because it's in thousands. If that didn't answer the question, feel free to send us a question at structureddata@sec.gov, and happy to engage further.
Great, thanks, Julie. And I have a question for Shelley. Shelley, this is kind of an interesting idea, is there or will there be an initiative for the DQC to develop DQC rules with the SEC for SEC developed taxonomies like FFD, SPAC, or RXP?
Yes, great question. And in fact, we already have DQC rules that check taxonomies other than US GAAP or IFRS taxonomies. For example, we have a number of DQC rules that check ECT taxonomy on pay versus performance disclosures, as well as insider trading arrangement disclosures. We also have a rule checking CYD taxonomy that's relating to cybersecurity disclosures. And of course, we'll continue to assess and create more rules that will check other SEC taxonomies that filers will need to use in their filings.
That's great, Shelley. Should we encourage anybody who has issues that they've identified with some of these taxonomies to send them in to you?
Yes, that's a great idea.
Okay, great. All right, let's see. Why don't we, I think those are all the questions that we have right now, but let's move on to our next section. And let me just skip ahead here. Sorry, we're going to be switching back to our other set of slides, so bear with me a minute. Okay. So first, I'm going to cover a couple of, actually, no, we don't have CPE questions right now. Sorry. Okay, our next session, we're going to give an update on data quality rules. And so for this, I'm going to turn it over to Campbell Pride. Campbell.
Thank you, Michelle. Okay, so I'm just going to go through a couple of things here. One, we have some rules that are out for public review. We'll go through those first, and then we'll do an update on some of the rules that have just recently been approved. And just so you know, these are available on our website, the public review rules. So if you want to have a look at them, please do. If you want to run those rules against your filing, you can run them and give us comments back. One of the things we do is we have a public review is so that we can identify if there are any issues with the rule. We really want to try and eliminate any false positives. We don't want those to come back so that people are trying to file and they're getting errors which aren't really valid. So please take a look at those rules during the public review process and let us know if you detected any issues. We do have a process where we go through and run the rules against a number of historical filings and look for errors and then confirm that they're valid. But in many cases, there are exceptions or there is something in a given industry which may affect you differently, or there may be state laws which mean that the reporting's slightly different. So what we try to do is we try to take all of those things into account so that we get very accurate rules. And that's an important part of the process. So nothing's too small to bring to our attention. We really appreciate the feedback. So I would encourage everyone to do that. All right. So Michelle's brought up the slide, and so we'll just go through some of these proposed rules and just give you just like a high level overview of what they do. So you can see this little blue on these saying US GAAP. These rules only relate to US GAAP filings. There are some rules that relate also to IFRS, and we'll get to those in a minute. All right, so the first rule, 203, is income tax authority axes with invalid members. This rule was actually added by the FASB. They had asked us to put this in, and this rule relates to there are members that you can use in the filing for domestic and foreign, and a number of the changes related to some of the income tax disclosure changes that were promulgated by the FASB. This is just really to pick that up. And so this is just clarifying that you shouldn't be tagging certain members. Particularly, you shouldn't be reporting values using the domestic country member or the foreign country member. These are kind of they are in the taxonomy, but they're meant as placeholders or headings, so that if your domestic country is the United States, then you should use the United States member. And if you've got tax that you're reporting in foreign jurisdictions, then you should be using those country names which are included in the taxonomy. So that just relates to the income tax authority axes. We ran some validations on. There's not very many errors on this. This is kind of, you can think of it more like a rule which just keeps everyone on the straight and narrow, so that if you actually do this by mistake, then it'll just let you know. It's more like a guardrail. It's not really addressed at trying to correct what's a major problem. Okay, so the next rule, 204, invalid axes used for tangible and intangible assets. This rule has a number of components, and really what it's trying to do is to address an issue that we've seen in some of the footnotes, where companies are reporting using PP&E elements, but then they're using tangible asset members, or the opposite. They're using intangible asset line items, but they're using tangible asset members to report them. And this really came out of work we were doing looking at capitalized software costs. And you can kind of put those in PP&E or intangible assets or disclose them separately. And this rule was just really intended to try and make that consistent. So the capitalized software costs was being reported in a consistent way. But then while we were doing the research on that, we noticed that there were other issues there. So this rule was put in to try and address some of the inconsistency between the line items and the members that were being used. Okay, the next rule, 205, which is invalid member used on the balance sheet location axes. So what this rule is doing is it's really looking at it's looking at what you've got on the balance sheet in terms of the financial statement captions on the balance sheet, and then it's looking at the notes where there may be disclosures, which are basically saying this is where this amount is appearing in the balance sheet. And the balance sheet location axis is really used when you've got a number you've reported in the notes, and then you're splitting it up, and different amounts are going into the balance sheet. Maybe some's going into current assets, or some's going into other current assets, and maybe some's going into receivables or whatever, if there's a split. And what this rule is doing is it just makes sure that the member that is being used on the balance sheet location axes is clearly aligned with what the financial statement captions are. So what the rule does is it goes and looks at the saying this is where this item appears in the balance sheet, and then it's actually making sure that that item actually exists on the balance sheet. So this is what this rule is doing. And we noticed some cases where there was inconsistency here. So this rule is just trying to bring that to your attention when you're trying to file. The next rule is 206, invalid member used on the disaggregation of income statement expense caption. So this rule works in a similar way. This rule is really aimed at the changes that are coming in the US taxonomy for DICE, which is breaking up the there's the breakup of the functional expenses, and in terms of making sure that you've got that broken up. And this was something the FASB has done, where they require if you've got like SG&A and how that is being broken up into the functional expenses that you may have. So the rule checks that filers use an appropriate member. There's an axis called the disaggregation of income statement expense caption, which is basically reflects the standard, which is the DICE standard. So then the rule identifies the expense line items used on the income statement and checks that they actually match with what you've put on this axis. So it's similar to the balance sheet. It's just making sure that there's internal inconsistency between how things are being lined up. So if you want to go to the next slide, please, Michelle. Okay, so the next set of rules really relate to schedule of investments, and this applies to what's called BDCs, which are business development corporations. It may apply to a company which is not a BDC if you are reporting a schedule of investments. And so what these rules are doing is really checking that the filings are in alignment with the guidance that's been issued by the FASB. So there's 4 rules here, and just real high level on these, because it may not apply to probably most people listening, but just so you know what they are. So there's a checks that the subtotals have been tagged correctly using the appropriate axes. There's a whole process by which these should be tagged. DQC 208 is making sure those the subtotals match the extensible enumerations in the schedule of investments. So basically it's making sure that, like, if you report something for a given industry, that you actually have that industry. It also checks if you're missing extensive enumeration elements, there's a requirement that you use those for certain disclosures. And any investment that you have, you're supposed to use the investment identifier axes. So it's checking that that's actually being done as well, and that's rule 210. Now, if you are a BDC, you may want to look at these rules and run them. And there has been some concern about this. These schedule of investments are very large, and in some cases, so making sure you follow the FASB guidance can be a little bit some people are concerned that the file size may affect their filing. So if you're looking at this, if you are a BDC, I'd recommend that you run these rules and have a look at them. And if you're getting lots of errors, please contact us and let us know, and then we can go through those and look at them. So we know particularly for Rule 209 does generate a lot of errors, because a lot of companies there's a little bit of vagueness of whether you have to comply with the FASB, but kind of the FASB guidance and the SEC guidance is kind of contradictory. in terms of whether you want to, if you have to report numbers or not. So this rule is just trying to address this to make sure that we basically get everyone tagging these documents in the manner that's been described in the FASB guidance. So it's not wrong necessarily, but we want to just get consistency. And the main driver for this has been coming from people wanting to use this data. We've had a number of people who use this information that's being reported because it's extremely valuable, particularly because it gives you an indication of interest rate yields in the private sector. So private credit is really interested in this, and different BDCs want to make sure that their loans are being priced accordingly. So this information is extremely valuable, and getting this data right, we've had a lot of complaints that it's been very hard to use the data. So that's really been the driver for these 4 rules. So if you're a BDC, you're interested in BDC information, then please provide a comment. Okay, so we go to the next slide, please, Michelle. All right, so those are the rules that are out for public review. However, we had a number of rules that just went effective in the last month. And so just to give a recap on these, if you run into them. So these all apply to US GAAP. So the first one is negative values for members on the statement of equity component axes. And what we tried to do in the last month is to try and clean up some of the problems we were seeing in the statement of shareholders' equity. It hasn't really been an area that we've focused on. We really focused on trying to get the primary financial statements correct. But there have been a number of issues in the statement of equity that we thought we should try and clean up. And it's been a little bit tricky to do this because a lot of the transactions that are reported here, there's a lot of things get grouped together, so it's not always clear what's the right element to use. So this is trying to address that. So negative values, so this means, people report dividends and they'll put it in as a negative because it's deducting from the statement of shareholders' equity when it should be a positive. We have a lot of non-neg rules, but these don't run on the statement of shareholders' equity because of it's a highly dimensionalized structure. So this is really addressing that. So you may see some errors for 194 if they come up, and this is just trying to address those. 195 is facts using an invalid member with the equity components axes. So like if you're issuing stock, you really shouldn't see an impact on retained earnings for that. So in some cases there are in strange circumstances. So the rule tries to take those into account. So for example, if you're issuing stock-based compensation, for example, but you're issuing it based on treasury stock and you bought the treasury stock back at a loss, and then you're reissuing them. So it may have an impact on retained earnings. So the rules try to take that into account. But if you find situations where you're getting an error for these and you don't think it should be an error, and there's a particular set of circumstances which mean it's not an error, we would like to hear about that. Then at least we can encapsulate that in the rule, and so we can make sure that those rules can be accurate as possible. Income statement items used on the statement of shareholders' equity. This is Rule 197. This is just checking that there's income statement items aren't appearing on the statement of shareholders' equity. And in some cases, people were getting confused. They would be putting stock-based compensation expense in there, and in other items, which there's separate elements in the statement of shareholders' equity. So this is just trying to make sure income statement items aren't being used there. We did get a couple of false positives on this, which we corrected, particularly related to partnerships. So if you have a structure or a legal structure which means this is okay and you're getting an error for it, please let us know, then we can quickly amend the rules so that you're not going to get an error on those. Income tax reconciliation percentages. This rule is, we have a number of rules that we've implemented to basically pick up some of the changes that are happening because of the changes to income tax disclosure. And this relates to doing reporting at the jurisdiction level. And we added some rules. These rules, a number of them won't kick in until later in the year until this is required to use this disclosure. But some rules may come up, particularly one of the checks that is in here is we are checking that the income tax percentage calculation is being done correctly, not only for the not only for the overall income tax, but for each of the items in the income tax reconciliation. And we've noticed some issues here. And so it'd be good to get some feedback on this. There are some exceptions, particularly again for partnerships and non-controlling interests. But the way this calculation is being done, it's based on net income from continuing operations before tax. We've seen some filers calculating the tax rate, including disc ops, which you shouldn't do. But if there are reasons or exemptions why you can do that, please let us know, and then we can incorporate those into the rule. So if you do get this error, we've also seen filers get this error, and it's, they've had a late change, and it's updated their net income there from continuing ops, but the tax rates didn't get updated to reflect that change. So I would recommend people run this rule, and if you are getting a percentage, you may want to look at it and just make sure that, one, the percentages have been updated, or you're actually calculating them correctly. So I think this is a rule that can actually help when you're doing a filing, just to make sure that those numbers are exactly correct. All right, so you want to go to the next slide, Michelle? There's a couple more rules here. US GAAP rules. Rate. This is the first one, 199. This relates to BDCs. This is just making sure the rate basis has been reported. Some cases filers weren't reporting this. This is like if you've got like a Prime or SOFR or LIBOR, which doesn't exist anymore. But if you use those base rates, need to be tagged, so you actually know what the effective interest rate is. So this rule tags that, and this is predominantly for BDCs. Another rule, 200, not many errors for this. The FASB asked us to implement this rule. It's just really checking if you've used instant items on the income statement location axes. You shouldn't be doing that. There are a couple of new axes that the FASB added in the last year or two to basically, if what was happening was filers would report an instant element, but it was really because it was like a journal entry. They were trying to capture the details of a journal. So this rule is just basically saying don't use the income statement location axes anymore. You should probably be using a couple of these other axes that were implemented. They're like an accrual axes. And then the final rule here is private company concepts. The FASB added a number of elements for private companies. These shouldn't be used by public companies. So there's a rule in there if you're a public company and you're using the private company concepts, just to flag that. Right, and I think we've got these are the last two. So these two rules apply to both US GAAP and IFRS filers. And Shelley mentioned this one before. This is the cyber taxonomy disclosures. And what this rule is doing is after a certain date, you need to make certain disclosures related to cyber incidents or what your cyber policies are. So what all this rule is doing is making sure that there is some cyber taxonomy disclosure. This is some cyber disclosure in the filing. And after a certain date, it'll flag if that doesn't exist. So it's basically just looking for any elements related to the site that have been used in the cyber taxonomy have actually been used in the 10K filing, and it'll only apply to 10Ks and 20F filings. And then Rule 196. This applies to both US GAAP and IFRS, and this relates to stockholders' equity. And it's looking at the opening and closing balances and making sure that you've used the appropriate elements for that. So in some cases, like if you've used the stockholders' equity the components of stockholders' equity axes, and you have the opening balance, you should be using things like stockholders' equity as the opening balance. There's a bunch of elements you should be using. You shouldn't be using additional paid-in capital, for example, with the additional paid-in capital member. So it goes and checks all those and just makes sure that the appropriate concept is being used. The rule takes into account if you've got an opening balance and then you had an adjustment, then you had a restated opening balance. So it handles that. So if you get this, you just basically want to have a look at that and make sure that it's you've used the right opening or closing balance on it. All right. I think that is all of them. Michelle, the next slide. Go to
Great. I think now, oops, I skipped ahead too far there. Yeah, I think we're going to go to CPE questions, and then we'll kind of double back and see if there are additional questions. So please, feel free to submit your questions. And but in the meantime, let's cover those poll questions first to make sure we get those. Okay. So we're going to go to this next question on custom tag use. And it's which type of SEC filer has the lowest use of custom tags in 2023 based on the SEC custom tag trend analysis? Is it smaller reporting companies? Is it non-accelerated filers, accelerated filers, or large accelerated filers? So please take a look at that. You've got about 30 seconds to respond to that, and we'll go to the next one. Okay, just like another 10 seconds here. All right, I'm going to close down this poll and we will go to the final question. Okay, which of the following rules generated the highest number of errors in 2024? Was it DQC 154, tax reconciliation items? Was it DQC 156, basic and diluted extension elements? Or DQC 158, related and non-related party access and extensible enumerations? So which of those generated the highest number of errors in 2024? Okay, I think we're going to close down that poll. Thank you all for responding to those. And the last question, which I think Julie actually answered it online, but maybe Julie, you could respond to this so that everybody can hear. Is there evidence that retail investors are using XBRL?
Yeah, sure. So we are aware of one research paper that looked at the analyst estimates, ratings, and target prices on Yahoo Finance. And it looks like their results provided some evidence that the analyst information, retail investors tend to rely on the analyst information that's summarized rather than going to the actual filing. We also have gotten questions from retail investors on our financial data sets in our inbox as well. So those are some use cases that we're aware of.
That's great. Thank you, Julie.
And and Michelle, just on that question as well. So from our perspective, like we have an API, and people can use that if they want to get data. And we have another number of individuals who we know hit that API pretty hard. People don't actually come out and say, I am a retail investor or I am a institutional investor on that, but we do, it's probably pretty clear that they're not from companies. So if they fall in that retail category, I'm not sure. It's a host of different people who are using it. You can get hedge funds and asset managers who are using this data. And then you've got people who work for maybe broker dealers, and they just use that as another way to check that source. And then you have individual people who who do a lot of investing, or they're traders, and so they're looking at that data. So it's hard to classify whether retail what that category is, because we don't really collect that information when we distribute this data. So it's across the board. But to Julie's point, a lot of this data is being used by data aggregators, which will then flow into data feeds, which then go into like broker dealers. So if you go and if you've got a Schwab account or whatever, and you're looking at this data and the analytics they do, that that can be flowing. It may not be direct usage, but it may be flowing through. But I know from our perspective, we have, I would call them more advanced users, and they come in and they're looking at their data and they're using it to, particularly when you got things like tariffs, people are coming in and saying, okay, what's exposure to China and what's exposure in which companies have a lot of sales there. So we've had a lot of requests for that type of data. So, when you need that data, people are looking for it.
Great. Thank you, Campbell. Thank you, Julie. And I want to thank everybody for participating with us today. Thank you so much to our speakers, Shelley Waveren from Topan Merrill, Julie Marlowe from the SEC, Campbell Pride from XBRL US. And thank you to all our attendees. I also just wanted to quickly draw your attention to a couple of additional events we have coming up that we hope you'll join us at. On May 21st, we have another webinar on 2025 meta model improvements. And this is going to feature Campbell again, along with David Shaw. David is Senior Project Manager of XBRL at the Financial Accounting Standards Board. And then finally on July, actually 30th and 31st, in Denver, Colorado, we're going to have GovFin 2025, Designing a Digital Future. And this is a 1.5-day conference. We're looking to bring in primarily government entities, state and local governments, as well as regulators and software providers. We're going to have 3 keynote speakers. We have David Walker, former United States Comptroller General. We have Deborah Austin, who is a JD PhD professor of the practice at the University of Denver's Sturm School. And another speaker that's just recently added is Dave Young, who is the treasurer of the state of Colorado. So we're very excited. We've got other speakers from GASB, the Ohio State Auditor's Office, Washington State Auditor's Office, as well as Colorado's Auditor Office and the Municipal Securities Rulemaking Board, and many more to come. So please check out the URLs that you see here. Please join us for some of these events. And I hope you enjoy the event today, and we'll see you more in the future. So thank you all again, and have a great day.